Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out with you today, talking taxes. Hopefully you're enjoying the program. Got a few minutes left. Wrapping things up today. First and foremost, we have our annual end-of-year tax planning workshop coming up in the next few weeks. It is in December 3rd to be exact, at the Mission Valley Sheridan. If you would like to learn more about how to mitigate your taxes before year end, I would encourage you to go to puretaxclass.com. You can go to puretaxclass.com. You could call 888-994-6257. There's multiple ways to register for the course. It will fill up. We will have a few hundred people there, and it's a lot of fun each and every year. So if you want to learn ways to mitigate your taxes before it's too late, 95% of the strategies you have to do before year end. That's why we do it right now in the next couple of weeks, December 3rd at the Mission Valley Sheridan. Love to see you there. Let's go to the true or false question.
If I have a loss from my rental properties, can I always deduct that loss against my other income? And the answer to that is false. You cannot always do it. In fact, your income has to be below $100,000 to deduct up to $25,000. Once it gets over $150,000, you can't deduct those losses unless you're a real estate professional, which is a whole nother matter. Now, we got just a couple more minutes, but I want to tell you guys about a strategy that is very popular and not too many people know about it. And that's when you're thinking about your charity. When you're thinking about your charity, there's a way to give future year contributions and deduct them this year. Let me explain. The way that you do that is you set up a special kind of an account. It's called a donor advised fund. All you do is simply take some of your dollars and put them inside this fund, and it can stay in that fund for as long as you want it to. And the year that you put it in the fund is the year that you get a tax deduction. So that's the key here. So
if you look at it like this right now, so let's say if I make a $5,000 contribution, right, each year, I could bunch that up and say, well, maybe I put $20,000 into the fund this year, get the $20,000 tax deduction, then I dole it out as I choose to in the several years to come.
That's exactly right. And the reason you would do that is if you're in a higher bracket this year than you're going to be in future years. You get that tax deduction right now, and later on in later years is when you give that money to charity at your discretion. There's no minimum or maximums. You can let it grow for 20 years if you want to, or you can start pulling it out right away and have it go to charity. Better yet is, how about giving away appreciated stock, because whatever it's worth is your tax deduction, and you don't have to pay the tax on the gain. It's just a really good way to create some tax deductions when you have a high income year.
Yeah, it's a great strategy. It's called a donor advised fund. So again, if you're looking at ways to reduce your taxes this year, if you're already giving a charity, check it out, the donor advised fund, where you can get a lot more deduction, a lot more bang for your buck, if you will, if you have a higher tax year, or you can combine different strategies. We talk all about this at our tax planning workshop, end of year tax planning. It's a big deal. It can save you a buck. It can save you hundreds of thousands, really depending on your specific situation. You just have to show up. We are at the Mission Valley Sheridan, December 3rd, 10 a.m. to 12 noon. Love to see you there. The number's right there on your screen. Call that number to register. We will see you in December, but then again, we'll see you again next week. For Big Al Clopine, I'm Joe Anderson. The show's called Your Money, Your Wealth. We'll see you next week.